When people talk about AI today, they talk as if it is a magic machine that turns dollars into more dollars without any chance of problems. Whenever the market becomes excited about something new, you start to hear the same kind of phrases repeated again and again. People say that this new invention changes everything, that old business rules do not apply, and that anyone who questions the story is simply behind the times. I have heard this pattern several times across my lifetime, and it rarely leads people to good decisions. What usually happens is that investors become so eager to take part in the excitement that they stop asking the basic questions they would normally ask about any business. They forget to slow down and ask what something really costs, how much it earns, and how secure those earnings actually are. It is the same behavior that shows up in every market craze. The names change, but the behavior stays the same. Right now, many investors are chasing AI companies with the idea that they cannot lose. They talk about AI the same way people once talked about the internet in the late 1990 seconds. Back then, everybody wanted to own anything with .com at the end of its name. People did not examine the business. They did not ask whether the company had real income. They did not check whether the product actually worked. They just wanted to be part of something that everyone else was buying. That way of thinking feels safe in the moment, but it is the opposite of safe. I saw many people lose large amounts of money because they treated excitement as if it were the same thing as value. When you combine the fear of missing out with a fast-moving story, it often pushes otherwise sensible people into decisions that look reasonable in the moment and foolish in hindsight. AI has real uses and real importance in certain areas. But that does not mean that every company involved in AI is a good investment. It also does not mean that people should ignore the basic math behind the spending required to build it. Many investors today act as if the only thing that matters is who can build the largest AI models, the biggest data centers, and the most advanced chips. They forget that building all of this costs an enormous amount of money. They also forget that cost does not disappear just because a company talks about the future. A business can burn through mountains of cash chasing the appearance of growth while losing sight of actual return on investment. If a company spends $1 and brings back 90 cents in value, that is not progress. You do not fix that problem by repeating the word AI. You fix it by examining the spending with discipline and asking whether the returns justify the cost. People often assume that if the technology is exciting, then the company behind it will automatically become more successful. That assumption rarely holds up when you study real business history. The airline industry changed the world, yet airlines struggled for decades to earn a good return for shareholders. The auto industry changed the world, yet many of the early auto companies failed. Being tied to an important technology does not guarantee long-term financial success. What matters is whether the company can produce steady, reliable earnings and whether it can do so without spending so much money that it erases every advantage it has. Many of the AI companies today are spending at a rate that would be difficult to maintain in a normal business environment. They spend hundreds of billions on chips, data centers, and power infrastructure. Investors look at this as a sign of strength. But heavy spending is not a sign of strength unless it leads to dependable and growing returns. A company that spends aggressively without clear long-term economics is not building a moat. It is digging a hole. A large part of the excitement around AI comes from the belief that it will replace or reshape nearly every type of work. People imagine a future where AI is woven into every business, every job, and every product. That may happen in certain areas, but what investors forget is that building systems at that scale requires constant spending. It is not like buying a factory that will run for the next 20 years. AI systems require ongoing training, maintenance, and hardware upgrades. The hardware becomes outdated faster than most people think. Models grow larger. Data centers become overloaded. Chips need to be replaced. Every new generation of AI requires new equipment. Investors who do not understand these costs see only the direction of the stock charts, not the balance sheet behind them. Another point that investors forget is that many companies are rushing into AI without a clear plan for how it will translate into stable revenue. They adopt AI because they are afraid to be left behind, not because they have a well thought out plan. When companies spend because they fear missing out, that is when costs pile up fast. Managers start spending shareholder money on projects that sound good but do not have a clear purpose. They hire teams without a clear role. They build tools that never reach customers. They buy hardware that sits underused. This is the kind of spending that can continue for a long time before anyone admits that it is not paying off. It is easy for managers to hide spending behind big words and big visions, especially when investors are not asking tough questions. But sooner or later, the numbers show up in the results. When a new technology becomes a trend, investors often feel pressure to buy something, anything, so they do not feel left out. They watch other people talk about their AI stocks going up, and they start to feel that they are making a mistake by not participating. They forget that the goal is not to own what is popular, but to own what will be valuable many years from now. Popularity and value are not the same thing. Many investors today talk about AI companies as if the race is already won. They assume that the biggest companies today will automatically be the biggest companies 10 years from now. But competition does not work that way. When an industry grows fast, new competitors enter the market. Governments step in with regulations. Costs rise. Customers become more selective. The future rarely plays out as smoothly as the early predictions suggest. Right now, AI companies are spending money at a rate that is difficult for most businesses to maintain. They build larger and larger data centers. They sign long-term contracts for energy sources. They buy chips that cost several times more than earlier models. They hire thousands of engineers. They acquire smaller companies to expand their capabilities. Investors cheer this spending as if it automatically leads to better results. But spending alone does not create value. What creates value is spending that brings back more than it consumes. When companies make a habit of spending without careful thought, it often takes several years before the problems become clear. By that point, investors who bought at the peak of optimism find themselves holding the losses. Some investors look at the rapid rise of companies like Nvidia and assume that the spending behind AI must be justified. They think that if companies are buying chips at this scale, then the demand must be secure. But demand driven by fear of missing out is not the same as demand driven by direct economic need. Many companies today buy more hardware than they can fully use because they are afraid their competitors might reach a milestone before they do. When businesses spend to impress each other instead of their customers, they create bubbles. The spending looks healthy for a while, and it benefits the suppliers, but it does not last. When the revenue taken from customers cannot support the costs required to maintain this growth, companies start cutting budgets. That is when reality catches up. We saw similar behavior during the early cloud computing boom, during the telecom build-out in the late 90s, and during the push into industrial automation in earlier decades. Large companies spent billions because they believed the future required it. Some of those projects paid off. Many did not. The pattern is always the same. People become convinced that something big is happening, and they forget that the numbers must still add up. Even when technology delivers real progress, the companies involved do not always deliver real returns. Investors who forget this distinction put themselves in a fragile position. AI also has a high dependence on external requirements that are easy to overlook. It needs strong energy supply, stable infrastructure, and continuous hardware improvements. These dependencies increase the risk. If energy costs rise, the entire business model becomes more expensive. If chip supply becomes limited, companies fall behind. If regulations tighten, training large models becomes harder and slower. Investors treat AI as if it is immune to outside pressures, when in reality it is one of the most dependent technologies ever created. Dependence adds risk, and risk must be priced into any serious investment decision. When you look at the enthusiasm for AI today, it becomes clear that many investors are not studying the companies closely. They are following a general story, not the specific details. They talk in broad terms about the future, but they rarely sit down with the balance sheets, income statements, depreciation schedules, and cost forecasts. They listen to interviews and conferences, but they do not ask whether the long-term economics truly work. If they did, they would notice how thin the margins are for many AI-related businesses. They would see how many companies rely on heavy reinvestment just to keep up with competitors. They would notice how uncertain the long-term revenue is for many AI services. These are the kinds of details that matter to investors who plan to hold a business for years or decades, not just for a market cycle. The crowd often believes that owning what is new makes them forward-thinking. But good investing is not about being early or trendy. It is about being right. And being right requires you to slow down and think independently. You must be willing to let other people enjoy their excitement while you focus on the parts that others are choosing to ignore. In the case of AI, the part most people ignore is the scale of the costs and the uncertainty of the returns. It is easy to talk about a future filled with intelligent machines. It is much harder to show the math that supports the spending required to reach that future. One of the reasons people chase AI without thinking carefully is that they have become overly influenced by momentum. They assume that the past 2 years of fast growth must continue in a straight line. That assumption ignores the history of nearly every fast-growing industry. Growth slows. Competition rises. Costs increase. Earnings become unpredictable. Investors who rely on straight-line thinking often find themselves surprised when the real world behaves differently. Those surprises usually come with a price tag. AI will change many parts of life and business, but that does not mean the current leaders will automatically maintain their positions. The companies that spend the most today are not guaranteed winners. Spending is not the same as value creation. The winners will be the companies that turn AI into stable, recurring income without burying themselves under the weight of enormous operating costs. The losers will be the companies that spend because the market expects them to spend, even when the economics do not support it. The truth is simple. Most investors chasing AI today are not studying the costs, the risks, or the long-term economics. They are following a story. Stories feel comfortable. Numbers require discipline. Anyone can repeat a story about how AI will change everything. But very few people sit down and study the businesses in detail. That is why the crowd keeps repeating the same behavior in every market cycle. They focus on the excitement and ignore the price they might pay later. Why Nvidia's growth story needs careful examination. Spending is not the same as investing. Far too often the two words are used as if they mean the same thing, especially when something new and exciting hits the market. But they are very different. Investment returns come from productive assets that generate more money than they cost to buy and run. Spending is simply money going out the door. When managers and boards confuse the two, they put long-term value at risk. I want to walk you through how that happens, why it happens, and what to watch for so you do not get caught up in the same mistakes. First, let me say this. Businesses must spend money to grow. That is obvious. You cannot make more without putting something into the sadder business. You buy a factory, hire staff, build a product, create a sales force. All of those are necessary. The problem begins when the link between what is spent and what is produced becomes tenuous. If a company spends $100 where it should spend $20 to get the same result, the extra $80 does not create value. It destroys it. And the destruction is subtle at first. The revenue numbers may look good. Growth can be impressive. Yet under the surface, return on capital is declining. If managers do not notice, the decline becomes permanent. One reason excessive spending destroys value is the erosion of return on invested capital. Successful businesses convert capital into earnings. Return on invested capital, the profit the company earns from each dollar invested, is a simple, telling metric. When spending increases faster than earnings, ROIC falls. Imagine a factory that cost $1 million and produced $200,000 a year in profit. That is a 20% return. If the company doubles its capital, outlay to $2 million, but profits rise to only $250,000. The return drops to 12.5%. The business is less efficient. Over time, that inefficiency compounds. The stock may trade higher because investors believe growth will catch up. But if it does not, the company will have to shrink or take write-downs. Those write-downs are painful for management and for shareholders. Another clear path to destruction is leverage. Companies that borrow to finance aggressive expansion can be fine when times are good. Debt acts like a lever. If earnings rise faster than the cost of borrowing, equity holders do well. But debt amplifies mistakes. If the expected returns do not materialize, interest payments become a burden. Cash flows that would have been reinvested or returned to shareholders are instead used to service the debt. When borrowing is done to cover operating losses rather than to fund a clear, profitable expansion, the result is often a deteriorating balance sheet. Creditors notice. The cost of borrowing rises. At some point, management has to retrench, selling assets in a depressed market or cutting crucial investments. That squeezing is how long-term value is destroyed. It is not glamorous. It is the result of poor discipline. A related problem is the allocation of capital to projects that look good on paper but lack real economic merit. Managers and boards get seduced by impressive-sounding initiatives, the latest technology, a big acquisition, a flashy marketing campaign. They approve projects because the story is compelling, not because the numbers are strong. In many cases, those projects show up as intangible assets, goodwill, capitalized R&D, or long-term contracts on the balance sheet. When those intangibles do not deliver the expected cash flows, the company must write them down. Write-downs are permanent losses. They diminish net worth and send a clear message that management overpaid or overinvested. Companies also make the mistake of confusing market share with profitability. Managers often pursue market share at almost any price. They pour cash into promotions, subsidies, or underpriced services to win customers. That can work for a time, but unless the new customers generate margins that cover acquisition and retention costs, the program ends in losses. In the long run, a large but unprofitable market share is worse than a smaller profitable one. Investors who focus on revenue growth without examining unit economics are setting themselves up for disappointment. Excessive spending also erodes financial flexibility. Cash is the grease that keeps a company running. When cash flows are tight because of high spending, the company has fewer options. It cannot react quickly to new opportunities. It cannot weather downturns. It cannot increase dividends or buy back shares when prices are attractive. Financial flexibility matters a lot in bad times. Companies that preserve cash during booms often emerge stronger after recessions because they can invest when prices are low. Those that spend aggressively during good times are left trying to cut costs during bad times, and cuts can damage long-term prospects. A further danger is the cultural effect of unchecked spending. When a company constantly throws money at problems, it creates bad habits. Employees learn to expect that money will solve issues rather than careful thought. The organization stops questioning projects that should be questioned. Middle managers stop pushing back. That lack of discipline spreads to capital allocation decisions at all levels. A culture that tolerates waste is a culture that will keep wasting. Over time, inefficiency becomes the norm, not the exception. Reversing that cultural rot is expensive and slow. Now, let us consider the role of incentives. Executives are often evaluated and compensated based on short-term metrics: quarterly revenue growth, headline earnings per share, or market capitalization. Those measures can be influenced heavily by spending. A manager can boost short-term sales by cutting price or increasing marketing. They can buy back shares to lift EPS, use accounting choices to smooth earnings, or make a large acquisition that temporarily masks underlying weakness. If compensation rewards these short-term moves, you will get more of them, and they erode long-term shareholder value. The misalignment between incentives and long-term performance is one of the most common causes of destructive spending. Investor behavior plays a part too. Shareholders can be fickle. When markets reward growth above profits, managers react. If Wall Street loudly applauds top-line growth, boards may put pressure on management to produce more growth, even if it comes at the cost of profitability. The desire to be liked by the market can push companies into spend-heavy strategies that make little sense from a value perspective. That is why investors must learn to look through the noise and judge management by consistent economic returns, not by how well they perform in the latest earnings call. Let us be specific about a few forms of spending that often destroy value. One is overinvestment in capacity. Companies, fearing shortages or higher future demand, may build excessive capacity. They justify it by scenarios that assume high utilization rates. When the demand does not reach those levels, the company is left with idle plants and heavy depreciation. The resulting per-unit costs are higher and margins suffer. Another form is overpaying for acquisitions. Companies often pay a premium for growth, synergies, or inorganic expansion. Paying a premium is acceptable when the expected returns justify it. It is destructive when the premium is paid for intangible benefits that never materialize. A third form is runaway R&D spending without a clear product roadmap or commercial viability. Research is important, but if it does not lead to profitable products, it becomes an expense, not an investment. Technology is a particular area where spending can go off the rails. Building state-of-the-art systems, data centers, or proprietary platforms can be justified when those assets create high barriers to entry and predictable revenue streams. But technology also becomes obsolete quickly. By the time a company completes a massive, expensive build-out, newer, cheaper solutions may be available. If the business model depends on a technology edge that cannot be sustained without constant heavy reinvestment, the economics can be fragile. The right way to look at such spending is to ask whether the investment will generate returns above the cost of capital for many years. If the answer is no, then the project is better left alone. There is also the problem of regulatory and policy risk. Big spending programs often presuppose a favorable environment. Governments can change rules, taxes, subsidies, or permit requirements. A company that has sunk large sums into projects reliant on a permissive policy framework faces the danger that a change in regulation will render those investments less valuable or even worthless. Good investors take regulatory risk into account. Bad investors assume the future will be like the recent past. Another subtle but important point is the opportunity cost of capital. Money spent poorly is not only a direct loss, it is also the loss of what that capital could have earned if deployed elsewhere. If a firm uses cash to fund marginal projects instead of buying a business at an attractive price or returning capital to shareholders, the lost opportunity can be significant. Smart capital allocation means comparing all uses of funds and picking the highest return option after considering risk. Too often, boards and managers do not make that comparison rigorously. Now, let me offer ways to spot companies that are at risk because of excessive spending. Look at the trend in free cash flow relative to capital expenditures. If CapEx keeps rising, but free cash flow does not, that is a warning sign. Look at operating margins. If margins compress each year despite high revenue growth, the growth is likely coming from low-margin activities. Observe working capital trends. Rising receivables and inventory that grow faster than sales can be a sign of aggressive revenue recognition or poor demand. Check the level of goodwill and other intangibles on the balance sheet. Rising goodwill from frequent acquisitions suggests that management prefers buying growth to building it organically, and goodwill write-downs can be a precursor to losses. Watch how management explains spending in speeches and filings. Is the narrative vague and filled with buzzwords, or is it precise and tied to measurable milestones? Finally, read the footnotes. They often tell you where the real costs hide. If you own a business or are considering owning one, Establish clear capital allocation principles and stick to them. A few practical rules help. Require projects to meet a minimum acceptable return above the company's cost of capital. Prioritize investments that expand margins or lower long-term costs. Prefer internal projects with clear payback periods before pursuing ambitious external growth. Be cautious with leverage and maintain ample liquidity. And align management compensation with long-term returns rather than short-term metrics. Boards must be guardians of capital, not cheerleaders for every bright idea. That role requires skepticism and a willingness to say no. There are times when high spending is appropriate. A company at an early stage with a clear path to dominance may need to invest heavily to lock in scale advantages. Infrastructure businesses, like regulated utilities, often require large capital outlays that produce stable returns over decades. The key difference is that such spending has a predictable payoff. You can model the future cash flows and come up with a reasonable expectation of returns. It is the uncertainty and unpredictability that make most modern spending programs hazardous. If you cannot sensibly model the outcome, you should be wary. History provides many examples. I have seen companies that poured money into once promising ventures only to see those investments evaporate. I have watched businesses buy market share with discounts and subsidies, only to discover that the resulting customers were unprofitable. I have watched management teams chase fads and pay dearly for their enthusiasm. The firm that survives and thrives is the one that treats capital as scarce and precious. Capital is not something to be thrown at a problem in the hope that it will fix itself. It must be allocated with thought, discipline, and humility. Let me conclude with the bottom line. Spending without high confidence in the returns is not a sign of strength. It is a form of gambling with other people's money. In good times, waste hides behind growing top lines and rising stock prices. In bad times, waste is revealed by shrinking margins, layoffs, write-downs, and often broken promises to investors. The smartest investors are not the ones who chase every emerging theme. They are the ones who ask the hard questions, read the numbers, and demand that spending be tied to measurable economic outcomes. If you do that, you will avoid many of the traps that destroy long-term value. So when you see a company talking about grand plans and large capital programs, do not let the story seduce you. Look at the math. Ask how durable the returns will be. Consider whether the company will still be profitable if a simpler, cheaper technology emerges. Watch for rising debt, compressed margins, and weak free cash flow. Those are the signs that spending is not creating value but destroying it. If you practice that kind of caution, you will sleep better at night, and you will likely do better over the long run. How excessive spending can destroy long-term value. Spending is a tool. Used well, it builds capacity, creates advantage, and earns returns. Used poorly, it eats capital and leaves nothing behind. The first principle is this: capital is scarce. Treat it like it is. When managers and boards treat capital as unlimited, they generate projects and programs that look good on PowerPoint and in headlines, but do not create lasting economic benefit. The slow bleed begins in lots of small ways that add up over years. Growth may look attractive at first, but growth without profit is a hollow thing. If you spend $1 and get back less than $1 in present value, you have lost. Over time, repeated marginal decisions that lose money compound into material loss. Why does this happen? There are several common failure modes. One is poor project selection. Managers pursue initiatives because they are fashionable, because they help the manager's career, or because they will boost the next quarter's top line. Those motives are human. They are understandable. But companies exist to convert capital into cash, not to provide executives with something novel to manage. A well-chosen project has predictable, above cost of capital returns. A poorly chosen project does not. Too often boards fail to insist on disciplined hurdle rates. They approve investments without stress testing the assumptions. The result is capital committed to low return uses. Another failure mode is incompetent timing. Capital projects have a timing element that matters as much as the size of the investment. If you build capacity or acquire assets at the peak of enthusiasm and before a real market develops, you own an expensive asset whose utilization will lag. Many investments assume rising utilization and price stability. When demand softens or competitors flood the market, revenues fall short and fixed costs remain. That mismatch turns what looked like sensible planning into a long-term drag on earnings. Overleverage is a related and especially dangerous route to destruction. Borrowing amplifies both profits and losses. Debt can be appropriate when the returns on new capital exceed the cost to borrow. But when debt is used to chase uncertain growth, it turns normal volatility into existential risk. Interest must be paid regardless of how well a venture performs. Companies with heavy debt have fewer options when conditions change. They cannot easily fund new opportunities, buy back stock, or smooth dividends. Creditors will tighten covenants or demand higher rates, which further squeezes returns. If earnings falter, the company may be forced to sell assets at unfavorable prices, make sweeping cuts, or take write-offs that permanently reduce shareholders' equity. Acquisitions are another way spending destroys value when done without discipline. Buying growth sometimes makes sense, but paying too much for it almost never does. The arithmetic of paying a high multiple for incremental revenue rarely leads to attractive long-term returns. When managers make acquisitions to mask poor organic performance, they compound the problem. Good acquisition policy means buying businesses at prices that, given conservative assumptions, yield returns above the company's cost of capital. Paying a premium requires equally convincing synergies and integration plans. These frequently fail to materialize. The consequent goodwill write-downs and earnings disappointments are not abstract. They reduce intrinsic value. A less obvious way spending hurts is through dilution. Companies often issue equity to fund ventures. Issuing shares is not inherently bad, but if new capital funds projects that generate returns below what existing shareholders could have earned, each existing share's claim on future profits shrinks in real economic terms. Shareholders then hold a larger piece of a business that produces the same or less cash per dollar invested. Dilution coupled with low return projects compounds wealth erosion quietly but effectively. Operating expense bloat is another common problem. Marketing budgets balloon because management wants to show growth in user numbers or revenue. Engineering teams expand because innovation is a virtue in rhetoric. Sales forces double down on incentives to hit quarterly targets. Over time, these costs become part of the fixed base. When growth slows, the company must either accept lower margins or cut personnel and programs that are hard to restore. The goodwill cost of layoffs and the loss of institutional knowledge are real and often costly to rebuild. We also need to consider the depreciation trap. Many spend-heavy businesses finance tangible assets, data centers, factories, specialized equipment that later become obsolete. Technology moves quickly. What is cutting edge today may be standard or outdated in a few years. Depreciation and impairment may not match the actual economic loss. A business can record a depreciation charge that understates the real decline in asset value, leaving investors unaware of the erosion until a large impairment is taken. That sudden recognition of loss shocks balance sheets and investor confidence. Hidden costs compound the problem. Large projects require supporting structures, regulatory compliance teams, additional legal counsel, environmental safeguards, and higher insurance. These ongoing costs often scale with the size of the project and are easy to overlook in the initial business case. When management excludes realistic estimates of these recurring costs, the apparent returns look better than they will prove to be. Underestimating the cost of ownership is a perennial mistake. Management distraction is another cost. Large spending programs command executive time. Mergers, major platform builds, and aggressive market expansions demand focus from the CEO and senior team. That attention is diverted from the core business. While leaders hunt opportunity, the basics, customer service, quality control, supply chain, reliability can decline. The results may be lower customer satisfaction, higher churn, and leaking profitability. Companies that attempt too many things at once often fail at many of them. Culture and incentives are central drivers of wasteful spending. If compensation rewards headline growth or market share over cash returns, managers will chase those metrics. Boards must design incentives that emphasize long-term cash generation and capital efficiency. Otherwise, you get behavior that looks good in the short run but destroys value in the long run. It is simple. Incentives shape behavior. Align them to the objective you want: real returns, not vanity metrics. Short-term market pressure is also pernicious. Public companies face the constant scrutiny of analysts and investors. When markets penalize anything but rapid growth, managers have incentives to spend to meet expectations. Buybacks, special accounting elections, and short-lived promotions become tools to smooth earnings and keep the market satisfied. This market-driven spending often leads to poor capital allocation decisions that look sensible until a downturn or a competitor exposes the weakness. Excessive expansion for the sake of market share deserves special attention. It is tempting to believe that dominating market share will yield pricing power later. But capturing share often requires steep discounts, heavy marketing, and subsidies. If the new customers do not generate repeatable, profitable purchases, the expansion is not an asset. It is a liability. Many companies have large user bases that produce little in the way of profit. Big numbers of customers look impressive, but without solid unit economics, they do not create value. Another point to emphasize is the interaction between spending and competitive reaction. When a company spends heavily, competitors respond. They cut prices, ramp up their offerings, or invest in alternative approaches. The initial spender then faces a market where margins have been pressured across the board. If the spending did not create unique, sustainable advantages, the competitive response erodes any temporary gains. Spending that merely matches what competitors can do is unlikely to produce durable returns. Regulatory and policy risk also alter the calculus. Governments can change rules governing markets, data use, taxation, or environmental compliance. Spending that depends on a favorable policy environment can be jeopardized when laws shift. Companies that made large bets under one regulatory regime may find the economics fundamentally altered when new rules arrive. Let's talk about how investors can see these risks before they become disasters. Start with cash flow. Look beyond revenue and focus on free cash flow after all capital expenditures and maintenance needs. If a company reports large capital expenditures but little corresponding free cash flow, ask why. Do not accept vague assurances that scale will fix margins. Ask for a detailed path to sustainable cash generation. Examine the quality of earnings. Are gains driven by recurring revenue from paying customers, or by one-time accounting adjustments, or generous financing terms to acquire customers? Track capital intensity. How much capital does it take to generate $1 of revenue today versus several years ago? If capital intensity rises sharply without commensurate margin improvement, the business may be on a poor footing. Scrutinize acquisition history. Frequent acquisitions financed with high multiples or equity issuance are a warning sign. Read the integration story. Has management historically met its synergy targets? If not, treat future acquisition promises skeptically. Watch goodwill on the balance sheet and any subsequent impairments. Look into R&D spending. Is it targeted and tied to specific product timelines and marketable outputs, or is it an amorphous number that grows every year? Good R&D yields products that customers pay for. Bad R&D is an expense that never produces economic benefit. Assess leverage and covenant structures. High debt may be manageable in boom times, but dangerous when conditions change. Check debt maturities, interest coverage ratios, and the flexibility the company has to refinance. Also evaluate working capital trends. Rising inventory or receivables relative to sales may point to slowing demand or aggressive revenue recognition. Investigate deferred revenue. Is it growing because customers prepay for valuable services, or because management is discounting heavily to recognize revenue sooner? Look at capital allocation patterns. Do managers prefer to grow by acquisition rather than by improving margins, repurchasing shares at sensible prices, or paying dividends? Frequent equity issuance can be a red flag if it funds purchases at high prices. Observe whether management repurchases shares when prices are low or only when prices are high. Smart capital allocators buy when others sell, not when the market is euphoric. Finally, evaluate management's explanations. Are they precise and measurable, or vague and full of jargon? Ask for measurable milestones tied to economics, payback periods, expected incremental margins, estimated utilization, and realistic sensitivity analyses. Beware of confident forecasts without contingency plans. Real managers acknowledge uncertainty and build plans that work across a range of outcomes. The remedy is simple, though not easy. Insist on better capital discipline. Demand that boards require robust returns and hold management accountable. Prefer companies that treat capital as precious and display a history of prudent allocation. Seek businesses with predictable free cash flow, low capital intensity relative to their economic returns, and a culture that rewards long-term performance over short-term optics. Not all spending is bad. Capital invested in a durable, monopoly-like business can earn excellent returns for decades. Infrastructure, investments that produce predictable cash flows also make sense. But the distinction matters. The former delivers returns that exceed the cost of capital reliably, and the latter does so with predictable certainty. Most of the spending that destroys value does neither. So, remember, money spent must be judged by the cash it will bring back, not by the story that accompanies it. The market applauds bold initiatives, but the true test is whether those initiatives translate into higher, sustainable cash flows per dollar invested. If they do not, the spending is not an investment, it is a loss in waiting. Keep your focus on the math, read the balance sheet, follow the cash, and when in doubt, prefer the company that treats capital with respect. That is how long-term value is built and preserved. What happens when hype outruns business reality? When an industry enters a phase where stories grow faster than numbers, you begin to see a pattern that has repeated itself across many decades. It looks new to people living through it, but it follows the same shape each time. The excitement lifts share prices well before the earnings have a chance to justify those levels. Managers begin speaking in broad forecasts rather than concrete results. Analysts raise expectations based on trends that have not yet matured. And investors feel pressure to buy because they fear being left out of the next big thing. This is how hype pushes its way ahead of business reality, and it rarely ends smoothly. In every cycle, you see the same early signs. Companies start spending heavily simply because their competitors are doing it. Instead of asking whether the spending will generate a solid return, they worry about falling behind in a race that no one has defined clearly. They hire faster than they need to. They build extra capacity. They commit to long-term contracts for equipment they may not use fully. They justify these decisions by pointing to soaring market size predictions, even though the actual revenue is still far away. When the story becomes louder than the accounting, you need to be cautious. This pattern is especially common in industries that involve new technologies. The early wins draw a lot of attention, and suddenly every executive feels pressure to talk about how the company will transform itself. The quarter-to-quarter statements may not show the progress, but the excitement keeps growing. People forget that growth only has value if it comes with controlled costs and dependable earnings. A trend can be strong for years, but it still needs to rest on numbers that make sense. When the market focuses more on narratives than on cash flow, problems start to pile up underneath. Hype encourages shortcuts. Instead of building products carefully, companies rush features to market. Instead of checking whether customers truly need a solution, they assume adoption will happen because everyone else says it will. Instead of keeping risk in check, they enter areas they do not understand because they think the rising tide will lift everything. I have seen this many times. When investors rely more on excitement than analysis, they let optimism replace discipline. The business then grows in ways that look fine from the outside but carry cracks that widen with time. Another common issue is that managers begin to communicate in a way that focuses more on impressions than details. They talk about big opportunities without explaining how much it will cost to get there. They present long-term visions without breaking down the steps. They highlight potential markets without showing how they will compete inside them. When hype builds, many people stop asking for specifics. They simply trust that the future will solve all concerns. But business does not work that way. The future rewards those who prepare carefully, not those who rely on trends alone. You also see a shift in how valuations are formed. Instead of looking at earnings, cash flow, and sensible projections, the market begins to price companies based on comparisons to other inflated prices. Investors say, "This stock is cheaper than that stock," even if neither is close to a level that the underlying business can justify. This creates a chain reaction where the entire group of companies rises together, not because they have earned it, but because the crowd expects endless growth. When expectations rise faster than results, even minor disappointments can trigger large declines. When hype leads the market, expectations often reach a point where no company can satisfy them. A firm may post strong earnings, yet the market reacts negatively because the results are not strong enough to match inflated hopes. The disappointment then spreads because investors realize they were relying on assumptions rather than facts. Once confidence weakens, people sell faster than they bought. You can see years of gains reverse within weeks. This is not because the companies suddenly became bad, but because the expectations built around them were unrealistic. Inside the companies, hype causes internal strain as well. Employees feel pressure to move quickly instead of thinking clearly. Departments expand without enough planning. Projects are launched without full evaluation. Leadership tries to keep pace with market excitement rather than letting the business grow at a healthy rate. When growth is forced instead of earned, efficiency falls. You end up with high costs, unclear priorities, and products that lack the polish needed to attract loyal customers. When the hype phase ends, these weaknesses become obvious. Another sign is that companies begin acquiring smaller firms that claim to have promising technology. Instead of focusing on their strengths, they chase everything that appears trendy. Acquisitions done in a rush rarely produce the synergies that executives promise. The acquired companies may not integrate well. Their technology may not scale. Their teams may not fit. The new culture. During the hype period, investors overlook these challenges. But once the excitement cools, they start asking why all that money was spent without a clear return. When the gap between story and substance widens, even good companies can suffer. The pressure to meet unrealistic expectations can cause managers to take risks they normally avoid. They might stretch their forecasts. They might take on more debt. They might accelerate spending just to signal that they are still part of the race. When a company's decisions are based on image rather than careful planning, long-term value weakens. The market rewards them in the short term, but the bill always arrives eventually. You can see this clearly in industries that have gone through hype cycles before. The internet boom in the late 1992, the housing market in the mid-2000s, clean energy in different periods, and now areas tied to artificial intelligence. Each of these waves featured great companies that built real value. But they also had many companies that rose simply because investors assumed the future would be bigger than the present. When a business depends on assumptions rather than demonstrated progress, its foundation is weaker than it appears. A major concern is that hype can cause companies to mistake temporary demand for permanent demand. When early customers adopt a product enthusiastically, managers assume that adoption will accelerate forever. They scale up production. They expand their workforce. They commit to large capital projects. But early customers are not the whole market. Once that initial wave slows, companies realize they built far more capacity than the long-term demand can support. This leads to excess inventory, layoffs, and cost-cutting measures that would not have been necessary with more cautious planning. Another challenge is that hype distracts investors from risks that exist even in promising industries. Every new technology carries uncertainty. Markets can change. Regulations can tighten. Competition can emerge faster than expected. But when hype dominates, investors assume the path will be smooth. They do not leave room for setbacks. A small problem then appears far larger because no one accounted for it. Good investors always leave room for mistakes. In hype cycles, many people forget that simple principle. When expectations are inflated, the management teams that act wisely often look slow. They do not chase trends. They do not overspend. They do not announce grand visions. They move carefully, which can make them appear dull compared to those who promise the moon. But when the cycle turns, these careful managers suddenly look far better. Their companies have lower debt, more efficient operations, and stronger balance sheets. They do not have to unwind overbuilt structures. They can simply keep doing what they were already doing. In the long run, the slow and steady approach wins. Another aspect is that hype often invites opportunistic behavior. You start seeing companies rebranding themselves simply to fit into the trend. Firms that had little connection to the field suddenly claim expertise. They use buzzwords to attract attention. Their stock price rises not because the company has changed, but because they use the right terms in their statements. This should be a warning sign. When companies shift their identity without real capabilities, the market becomes crowded with firms that lack the substance needed for long-term success. Once hype fades, the market begins to demand proof. Analysts ask tougher questions. Investors examine the details instead of the promises. The companies that relied on momentum struggle. They cut costs, cancel projects, and scale back. Their valuations fall to levels that match their actual earnings potential. Some may survive and eventually thrive, but the path is much harder because they built their strategy around excitement instead of fundamentals. The companies that avoided the hype, however, are in a stronger position because they focused on durable results. For investors, the key lesson is simple. Numbers outlast enthusiasm. A business that earns steady cash, controls its expenses, and treats its shareholders fairly will make money over time. A business that relies on hype to support its valuation may deliver temporary gains, but those gains disappear quickly when perceptions shift. The job of an investor is not to chase the latest trend, but to evaluate whether a business has the foundation to support its valuation through good and bad times. When hype outpaces business reality, even a great company can look overpriced. The business may continue to grow, but not fast enough to satisfy inflated expectations. If the valuation is based on perfect conditions, then even normal conditions can disappoint. That is why I always remind people that price matters. A good company at too high a price can be a poor investment. A good company at a fair price is far better. And a company that depends on hype to justify its price should be approached with caution. You do not need to predict the end of a hype cycle to protect yourself. You simply need to focus on what you can measure: earnings, cash generation, debt levels, capital allocation, and competitive advantages rooted in real performance. If these elements do not grow alongside the excitement surrounding an industry, then the market is putting too much weight on the future and not enough on the present. In the end, when hype outruns business reality, the correction that follows is not a surprise. It is the natural way markets bring prices back in line with fundamentals. The companies built carefully will survive the downturn and continue to grow. The companies built on inflated expectations will struggle, and the investors who stayed grounded will be in a position to buy strong businesses at reasonable prices once the excitement settles.